I think we're going live now. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Tuesday, May the 6th. I'm delighted to be joined by three of our regular speakers here today. Vandana Hari, founder and CEO of Vanda Insights. Let me start by welcoming you and saying good morning and putting the question to you, and I might put this to all our guests this morning, what is behind OPEC Plus's sort of doubling down on output increases, do you think? We've had a few surveys this week which have said all of the above. Is it market share? Is it internal discipline? Is it geopolitics? What do you think is driving this somewhat counterintuitive move if we think about the outlook for growth and what the economy is telling us?
Yeah, hi, Diala. So I think counterintuitive was probably when they did it the first time around. I think that was quite a shock to the market when they decided in April to triple the boost for May. I think the decision they took on Saturday to do the same for June was pretty well telegraphed to my mind. The 8% or so drop that you saw in Brent futures through last week was pretty much baking in this decision, which is probably the reason you don't see that much more of a downside coming into this week. If anything, crude's perking up quite a bit since this morning. Brent back above $61. As to the reason, I do believe it has to do with perhaps Saudi Arabia, perhaps some other like-minded disciplined members of the group of 8 who just thought it was, enough was enough. And the 3 members, especially Iraq, Kazakhstan, and Russia, need to start delivering not just on quota discipline, but on their compensatory cuts. So I think the whole compensatory cuts, to my mind, and this is not just this year or now, I think since last year, we've seen it's become a bit of a self-perpetuating cycle, or an endless cycle. They continue to violate not just their quotas, but violate the pledges made under the comp cuts, and then as a result, then they promise new comp cuts, and it just goes on and on. And OPEC is as much about doing as it is about image and credibility. So beyond a point, if you keep doing that, and every couple of months you come up with a new plan for comp cuts, and then 2 months later it is revised again, you sort of start to lose credibility in the market. Not to mention that I would suspect that the 5 of the 8 members who were, more disciplined, who are more disciplined about their production, probably had enough of this. So this is like, if you can't pull back, they're saying to the 3, if you can't pull back enough, we'll race ahead. And, it is, after all, it does boil down to market share. How long are these countries going to?
Yeah.
So there is internal competition amongst the 8 as well. We shouldn't forget that.
Okay, thanks, Vandana. Thanks for that. Ilya Butchev, managing partner of Pentathlon Investments and author also of Virtual Barrels, one of the books that you have come out with. Ilya, welcome again. I mean, would you agree with Vandana? Is this a market share tendency? We're fed up. A few of the members who've been sort of taking the slack. A lot of commentary this week that no, this is more political, geopolitical, that actually OPEC Plus, led by Saudi, is doing the US a favor. I'm not sure if it is a favor, but where's your assessment of what's behind
I would agree
these recent moves?
Yeah, I would agree on some. I would disagree on the others. Otherwise, we're not going to have a debate. So let me start where I would agree. I would agree on image and credibility for sure. I think from my perspective, one of the main reasons why, first of all, I think OPEC is doing absolutely the right thing. One of the main reasons why they did it, simply because they can. I think for at least a year, I think they can get away with it now. For at least a year, everyone was arguing that the market is massively oversupplied. But at the end of the day, we haven't seen it in inventories. So these days, we all know it's extremely difficult to measure both supply and demand. The only observable data is inventory. And if inventories hasn't built materially, why not try a little bit more? Why not push and see if we actually gonna see some build in inventories, especially during the season when the demand is strong? So to me, the reason, in my opinion, is very simple. Is like, why not? Where I agree with Vandana is like image is important. They actually want to be seen. They're in control. They're in control both the market and the house, house of OPEC. So where I would probably disagree, I'm a bit skeptical about the goal of punishing non-compliant countries.
Right.
I think I would probably take the other side of it. If anything, the geopolitical argument here, in my opinion, is a little bit more important. Look, President Trump is visiting next week. There is a bigger fish to fry. I mean, a few 100,000 barrels, yes, it looks like important, but you want to welcome US president. There's the arms package being discussed, nuclear agreement being discussed. I'm sure pricing is going to be discussed as well. And to be honest, we'll probably get to pricing later in this podcast. I actually don't think a US president wants prices much below $55 Brent or something like this. But to me, the main reason, I think they just did it because they can.
Yeah, absolutely. And as you said, the US has also, as a producer as well, obviously, it has certain considerations. We'll talk about that. Thanks very much for that, Ilya. June Go, Senior Oil Market Analyst at Sparta Commodities. Welcome again. Thanks for joining us. What is all of this doing, June, to the refining market, and how, the volatility in prices that we've seen the last month or two, particularly 20% drop, and the uncertainty over the trade tariff sort of impact on demand going forward? How is that impacting the refining sector stakeholders and how they're in their planning?
Right now, we are seeing that refining margins are at a 2-year high. Melbourne simple margins, last I tracked, is about $4 positive per barrel. And cracking margins at $7 per barrel. We are seeing basically the price of oil, the feedstock is significantly cheaper than what the refined products are. And interestingly, the products market is still fairly backwardated. So there's still a very strong demand for products. Whatever we are thinking in terms of weakness in the economy, the macroeconomy, is not yet seen physically. So the market is still signaling, take the oil, run it in refineries, run hard, run full.
Yeah, and of course, we're now sort of halfway, well, at the beginning of Q2, coming up to a pretty strong season for refined products, generally gasoline, jet fuel, travel. Is that what's driving it? I mean, the planning for that, or is it a catch-up or response to weaker refining margins that, of course, we saw in the last couple of quarters?
It's a bit of both. So Q1 was a little bit weaker, so there's probably a bit of underrun at the point of time. We are now coming out of the peak turnaround period, so stocks are naturally low and needs to be replenished for the expected demand in the coming quarter. At the same time, we also have the seasonal crude and fuel oil power burn requirements in the Middle East. So all this will actually, eventually lead to expected product cracks being strong. Yeah.
Okay, thanks, June. Vandana, I mean, we have an article on our bulletin today that Saudi has increased its OSP prices to Asia. Again, I mean, we're trying to interpret what the thinking is, by countries like Saudi Arabia. They're increasing volumes into the market because they can, but also logic would tell you that's because they think demand is quite strong or is okay. Right, is healthy enough to do that. That includes raising OSP prices to Asia. But again, is that a tactic, do you think, or what do you think's behind that in terms of the June prices?
Yeah, interesting question, Diala. I think I wouldn't read too much into it's a small increase in the OSPs to Asia, which followed huge drops. It's not like they've made up all the way. They have dropped prices to other parts of the world. So, okay, it might be that they are thinking that perhaps Asia is coming back a little bit stronger. We do know that China tends to dip into the market to buy and, stock up their inventories when prices are lower. But again, as I said, I wouldn't really read too much into, I think it was about 20 cents higher for Asia.
What is the Chinese demand telling us these days about their projected sort of support for prices?
Yeah, so on a very short-term basis, it's hard to read because, as I mentioned, they come into the market and they just buy up. Also, as and when the Venezuelan and Iranian sanctions bite a little harder, we find, China turning a little more, buying a little more Russian crude. But even then, it's more Russian crude rather than more Saudi and Middle Eastern crude. So it's really hard to say what they're up to. But taking a slightly more sort of medium to longer term outlook, look, I don't think the Chinese economy is faring well at all. We do know that the manufacturing already slipped into contraction in April. We saw the data come out in recent days. And even before that, the Chinese manufacturing, which is like the big engine for the growth in the country, had just barely sticking its head into expansion territory. And now with all of these massive US tariffs, it's getting dragged down. Just to add a little bit to June's point earlier as well, in terms of refining margins, I would keep a very close eye on how diesel performs in the coming months. So what it's been like in the past few months and what it is in terms of refining margins, what it is and fuel demand, what it is like now. I think that picture is going to be quite a contrast to what the future coming months will look like if these trade disputes are not resolved. So, manufacturing contraction in China is a big deal, but it's also contracting in Europe and US. So, and if people aren't feeling that good about their job markets, their career prospects, and so on, you're going to see spending go down as well. So, jet fuel and gasoline demand, all of that will start showing up, I believe. I would be surprised to see continued strength in refining margins.
It's certainly going to be an interesting time to see how that plays out, right, ahead of the travel season. I mean, already seeing less travel to the US, for example, for geopolitical reasons, perhaps, or political reasons. And of course, the trade tariff uncertainty hitting projections. Ilya, let's talk a bit about oil prices, because we saw, as Bandana was mentioning earlier, a little bit of support coming back today. But, we've seen a big drop, obviously, in the last few weeks. And with oil being added to the market, I mean, how low do you think we can go with these prices beyond where we are today, holding sort of in the low 60s or at the 60 level?
Yeah, I think it would be very unprofessional for me to say that we have seen the lows. But to be honest, that's not terribly far away from my current thinking, because, as I said earlier, OPEC increased production because they can, and this is exactly what the market is saying. So OPEC increased production, and we're already higher in price than we were before the increase. So that means the price is already low. So that's actually a very good time to increase the production, because there is a natural floor on price that could be driven by completely unrelated reasons. I mean, there is substantial pent-up financial demand for oil as well. Essentially, there was a lot of selling over the last few months by the financial participants. And the reason for that selling, they were basically looking for oil as a hedge against recession. So, and if somehow we bypass the whole recession thing, that gigantic amount of selling has to be covered. But also, if you look from the broader perspective, oil is an asset at the end of the day. It's similar to like gold, and you see how cheap oil is relative to gold. The stock market already essentially shrugged off all the recession fears and recovered most of the losses. The oil hasn't done it yet. So oil is really, really cheap based on any metric you can imagine. And if you look from the financial portfolio perspective, I would say there is just a shortage of investable assets in the world. So there is still too much money in the world chasing for any assets. And at the end of the day, oil is an asset. And you can see if it gets to the levels $55, $60 Brent, where fundamentally you should see some sort of a curtailment of production. Because look, $60 Brent, that's what, 56 WTI, that puts you at $45 in Canada. And then $45 in Canada, I mean, you're going to start seeing some sort of a production curtailment, and in the US as well. So there is some natural floor. And as I said, I don't believe President Trump wants oil below $50 WTI, because then we have an issue in US with US producers. So I would say, again, we're probably maybe $5 above the floor. I can see oil can drop another $5 because algorithms still have a little bit of a dry powder, but honestly, not a whole lot. So I was estimating roughly maybe another 100,000 contracts they can sell. And I give or take, I use a rule of thumb, 20,000 contracts is $1. So that's to me at most $5. And if you're looking at the market, your downside is at most $5. Again, why not try to increase the production now? Because the market can be supported by other
factors. Yeah, and of
There's
course,
basically just more at $50. I would say there's just not enough sellers at $50. Other than the algorithms. So the discretionary folks are unlikely to sell at $50, regardless of how bad demand is in China.
Okay, thanks, Ilya. June, I mean, on the again, back sort of to the margin front, but let's talk a bit about just Chinese refining, if we can, in terms of, again, they've been buying up a lot of crude and putting it in inventory because of, favorable prices, as they would usually do. The export refined product quotas was set at the beginning of the year. There was a bit more flexibility this year. Where are we at there, the second quarter in China, in terms of its outlook for exporting some of its refined products into the region?
I think
and the health of demand.
They issued a second batch of product export quotas a bit earlier than last year's quota announcement. So it seemed to be a little bit bearish. That means internal demand probably weaker, and they need to still run the same amount of oil and therefore export a bit more. But we haven't seen anything substantial coming into the rest of the world, particularly Southeast Asia. Normally, you have seen a lot more exports based on that product export quota. So it means internally they are consuming those oil, and probably another reason is the independent refineries have been on the lower side of the run rates due to the initial year's concern of the Iranian sanctions, and initially seeing a little bit of drop of a flow going into these independent refineries. However, in the recent months, we have started to see a lot of that being picked up, and therefore the independent refineries run rate also increasing. So we should start to see those product exports coming up pretty soon into the market. So in terms of China demand itself, I think there were some positive news. Over the weekend, the May Day holidays, heard about 8% increased spend versus last year. So it's not all doom and gloom in China. But we will start to see that impact of all those the incremental tariffs hitting China and the US pretty soon. It's a bit strange to think about it, but it's only about a month ago when those announcement was out. So all the impact of the shipping activities will start to be seen very soon.
Yeah, I think that impact is still to come, isn't it? I mean, it's been the rhetoric now, but the actual physical impact of the ships and the cancelled exports from China and the draw on oil, of course, on demand, that'll also start to show. I mean, Vandana, talking about Chinese sort of demand also, and what crude it's taking, it has lessened its intake of Iranian crude as a sort of preamble to, Trump's maximum pressure campaign on Iran and kind of playing that game. But also India has been a big taker of Iranian crude. I mean, not as much as China perhaps, but again, buying the cheapest barrels that it can on the market wherever they're available. There's an article today about Saudi and India with their joint plans for refining, and that Saudi would want those refineries to take Saudi crude, but India's going to continue to take the cheapest crude it can get, right? And what's the outlook for that in terms of what it's been taking from Russian supplies as well?
Yeah, absolutely. So whether it is for existing refineries or new joint venture refinery projects that India plans especially with any of the Middle Eastern suppliers, look, India knows that its strength. It is a market. It's a growing market. It's growing and expected to grow at a much faster rate than China in the coming years. So it's a coveted market, and it is a buyer's market as a result. The report that you're referring to, so it was, I think, something similar to an MOU or don't know if it was sort of a letter of it was a preliminary agreement, which, the kinds that tend to be sort of signed with a, not signed, rather agreed on with a handshake, and then the devil is always in the details, isn't it? So India has been courting Aramco, other Middle Eastern companies if they want to, for joint venture refinery projects. The fact remains that in India, if the government believes that India should continue building its refining strength, and which is the current belief, they're not really beholden to external investment. They don't really need it. It's just one of those, energy security things. If you need they'll find money. They have the money to invest in new refining capacity. So the whole idea to have somebody, a major crude supplier, invest in it from India's perspective would be, okay, so you're going to now get a share in the booming Indian fuel market, and what does India get in return, right? So you can't sell crude to us at OSP because that's what we would get in any case, right? So it's sort of like, from India's perspective, a fair give and take in such a situation with a joint venture partner, bringing in a joint venture partner like Aramco or ADNOC or any of those companies, would be that, you have to give us crude at a preferential rate.
There has to be an advantage, obviously, yeah. Thanks, Vandana. There's our question today, which is relating to prices. We were just talking about that earlier. What would be the floor that would trigger OPEC Plus to reverse its planned output increases? And there's the range, 55, 45, below 40 even, or no floor at all. Ilya was saying we have perhaps another $5 to go before things kick in, which would take us to number one there. Ilya, let's talk a bit about also the bigger picture. I mean, in the context of Russian crude as well, sanctions. I mean, part of the what Trump is doing is trying to put pressure on Russia to come to a Ukraine deal, and perhaps through this price strategy with OPEC, as many people are saying. But where are we, do you think, with where Russian crude is impacting the market these days? And do you expect that to shift in any way from the dynamics that we've seen play out the last year or two, really? Will anything change for any reason?
Yeah, I don't honestly know. I don't think I have a particularly strong insight. The geopolitics are important, but look, trying to speculate what's in U.S. president's head in terms of geopolitical strategy, I just don't know. Obviously, I think the lower price.
What about what's in Russia's head and Putin's head?
That's equally tough. That's, to me, that's just like I don't think I have a good story there. But clearly the preference for lower prices is part of the strategy to basically push Russia into negotiation. So, but I really don't have any particularly strong insights on that, unfortunately.
And I mean, you mentioned, sorry, Ilya, in your previous comment about Canadian cost of production, and more importantly, US cost of production. I just wanted to go back to that.
Yeah.
Obviously, a lot of the producers in the US not happy already where prices are at. How is, I mean, and of course, Gulf producers obviously want the prices higher if they can. But from the US sort of non-OPEC supply point of view, is that a strategy, do you think, that's going to please OPEC? I mean, it might be doing something to help the US in one way, but also it is helping by minimalizing any growth in that production from the US to come,
I mean,
right?
US producers and OPEC, at the end of the day, they both want higher prices. I think they're confused now. They also don't know what to expect from Trump. You have actually seen, somewhat surprisingly, a wave of recent producer hedging over the last literally couple of weeks, where they were fairly quiet on the hedging side, but now there is so much uncertainty where, okay, if you can still lock in your $60 oil or $55 even oil for a couple of years, it's not great, but that's okay. So they are trying to protect themselves just in case, because what if the president doesn't stop? They actually, in my opinion, they do think that the common sense prevails, And at the end of the day, the president is using lower prices in some of his geopolitical strategies, but they don't think, and I don't think he wants prices below $50 WTI.
Yeah.
So we kind of we all agree on that. But just in case, you can see that they are actually trying to reduce some risk by hedging. That's something that OPEC cannot do. So if anything, so to a certain degree, U.S. independent and Canadian independent has some sort of a competitive advantage by being able to reduce these risks that OPEC cannot. But ultimately, OPEC and U.S. producers have the same goal, really.
Yeah, absolutely. And they would maybe have the same floor that they can tolerate. June, back to product movements also. I mean, there's been a lot of obviously news about shipping from a trade point of view, what's happening to that, but also from a geopolitical security point of view, certain, rerouting has now become commonplace around the Cape of Good Hope, etc. And no real improvement in flow through Suez, for the same reasons that had started. I mean, any expectations there from the refined products market on terms of where product flow may be pushed because of those shipping limitations, shortcuts being taken by certain exporters, regarding the dark fleet, etc. That doesn't seem to be improving in any way, and countries still seem to be getting around pushing and taking, supply where they want to without proper monitoring.
I think right now there really is not much change in the flows. There was all this hype that the Suez Canal is safe again, and then obviously the attacks from the Houthis kind of disrupted the flow again. I think more importantly is how big refineries react in the current environment. That will change the trade flow more on product side. And the main one is indeed Dangote. Recently, we heard their refinery is still having a prolonged outage on their RFCC. And this will be very supportive to the gasoline market. And it will add length into the low sulfur fuel market. And they were supposed to go for a maintenance as well after this unplanned downtime. So if it does come back in July, then we will see a material change in trade flow. Otherwise, there will be repercussions to those markets that I talked about.
Okay, thanks, June. I mean, Vanda, just back to the China angle. You of course, we've mentioned its economy is not doing great, but it's okay, and there's more stimulus coming in as well. And of course, but I wanted you to give us your point of view from the trade sort of tariff rhetoric with the US point of view. A lot of people saying in the last week or two, China's gained the upper hand. First, it didn't even respond or engage in terms of meeting with the US. And that, it actually, despite its reliance on goods exports to the US, might long-term have the upper hand in this particular tariff war. Would you agree with that? From a sort of political point of view, does it have more time to play with or less domestically?
So in this whole, it's in this whole China versus US debate, I feel there's the signal to noise ratio is pretty bad. It's very, very noisy and a lot of rhetoric. And, rhetoric is something markets are used to and you could still live with. But a lot of the other, because there isn't that much coming out in terms of official, you see a lot of sort of semi-official sources said kind of news, and depends on, whether you're reading Chinese press or Asian press, or whether you're reading the Wall Street Journal and more, sort of US leaning press, and you see people arguing one way or another that, clearly China has more staying power, China has the upper hand, or, some people are arguing it's the US. From where I sit, and, I read both sides of the argument, to me, it's, it feels like it must be pretty obvious to policymakers on both the sides in Washington, D.C., as well as in Beijing, that the current situation is just simply untenable. I mean, it's hurting. It's already hurting both countries, right? So we saw, as I mentioned, Chinese manufacturing has almost seized up. The trade between the two countries has almost come to a screeching halt.
Well, that's huge. Yeah.
Yeah, we saw what US front-loading imports in the first quarter. We saw what it did to US GDP in the first quarter. So, I think it's pretty clear. There probably some ego, some sort of posturing to get the upper hand as they come to the negotiating table. I think all of that is going on. I would, as a result, just caution against reading too much into the sort of arguments that which side has the upper hand.
Yeah, I mean, I think one opinion has been that they're going to come to the table pretty soon because
Yes.
time's up for both. Yeah, Ilya,
Yes,
thanks, Vandana. Ilya, I'll give you one more minute. Sorry, Vandana, to cut you, but I wanted just to get Ilya's thoughts
yeah,
on,
sure.
just because I wanted to talk about just quickly. We've run out of time, but the Fed policy and how do you think the US Fed is managing to plan, Ilya, going forward on this? There's another meeting obviously coming up in May. Increasing or decreasing interest rates is still in question. Can they act in any way with all this confusion, or do you think they'd hold steady for now?
I mean, I think there are a few cuts is currently priced in, and I actually think the market is more or less right. I think they're gonna cut.
Okay.
I think it's fairly consistent now.
Oh, so you think they will proceed to do that?
Yeah, I think so.
Okay. All right. Okay. Thanks very much to Ilya and Vandana and June for joining us this morning. There's a pretty equal result, which is kind of surprising. I thought we'd get a bit more on the number one up there, but some pessimism that we could go below that. So there you go, everybody. Thanks so much, everyone, for joining us, and have a good week ahead. All the best.
Thank you.
Thank you.
Thank you.
Bye-bye.